Welcome, everyone. My name is Brendan McCarty. I am CIO and founder of Colony Advisors. Welcome to our May report on the strategies of Colony Advisors. This is our first video post we have done in a little while, and hopefully you like it. In our outlook for 2022, our base case scenario for the markets was lower equity returns, poor sentiment, erratic trading conditions, and a weakening economy. Most of those conditions have played out, with the weakening economy variable playing out since the end of April, as the markets have tightened substantially through rates, financial conditions, and the like. This view is largely based on our thoughts that the 2022 would look like 2001, and so far that has played out. Through all this tumult in the markets, our strategies at Colony have done well. We were up for the month of May, while the indexes were basically flat for the most part and remain lower for the year. Part of the reason for the volatile swings in this market is what we call the crossroads. What are the crossroads? It is the point in time where the bulls and the bears are at equilibrium. The bulls were clearly in control for much of the past 2 years, but the bears gained some traction over the last several months as the S&P fell, NASDAQ fell more substantially. At the crossroads, it's the point in time where either the bull market evaporates and the bear market takes control for up to 18 to 24 months, or it's the ultimate in terms of buying the dip. At Colony, for the month of May, we have maintained the stance that we're more to buying the dip right now than selling the rip. However, we are doing both because at the crossroads, you don't follow a trend one up or down. You follow it where it goes. In terms of our trading, that hasn't been as easy as those conditions have been volatile, to say the least. Trading has changed course in the middle of the day and extended for long periods of time through the middle of the night. That kind of messes up timing on various trading positions that we use. However, our trend following trading, which is a little bit more complicated as we are at the crossroads, has done well as we shorted the market down in May and bought the dip as well. This led to outperformance, as mentioned. For June, we're still trading the crossroads as well with the same exact profile. Our positions are a bit smaller as we're out of the strong period of the year. We're entering a period of year where returns are less predictable, if you will. Vacations start to take hold, kids are out of school, liquidity tends to dry up. Thus, we take our position sizes down. However, our trading directions will remain the same as we will look to trade the trend and trade in the short term as well. As you can see from the returns for the month, all three strategies were higher, with Harbinger LR performing the best. Harbinger LR is our flagship strategy. It benefited from moves up and down. Torrent also did well, benefiting from the down move this month, not the up move, because that's not the way the primary trend is positioned at the moment. Harbinger Enhanced is just a mini-me version of Harbinger LR, trades exactly the same way, just with a lower risk profile and a higher exposure to cash-bearing instrument, interest-bearing. So for the charts of the month, we have two. First is the S&P's valuation. We don't trade on valuation necessarily in our models at Colony. However, it affects the primary trend and it is a reason for investors to buy or sell. So we broke the last 22 years of market history into two periods: pre-global financial crisis to 2009, and post-global financial crisis after through today. As you can see, those periods were quite different in terms of the cheap to premium valuation. Why was that? We believe it is due to quantitative easing. More money in the system creates a bigger Fed put. Investors are more emboldened to buy. Thus, the S&P trades at a major discount to its 10-year average PE and bounces every time it hits it. Pre-global financial crisis, when quantitative easing didn't exist in the market and the Fed put did not exist in the market as greatly, there's more interest rate movements. You can see as the Fed was tightening post-2000 bubble, the market traded at a discount to its 10-year average PE, which was inflated by the bubble. So you can see how that played out. We believe the month of June will tell us which way we're going. If we did bounce at the end of May off the 10-year valuation. We are tracking towards a little bit as the month of June has started. If it continues to trade below it throughout the month, that could be a good indication that we're pre-global financial crisis going forward. If we bounce and start rallying, we're back to the same old, buy the dip, sell the rip eventually. Second chart of the month is our breadth picture, which we have shown several times on these pages, as well as in our top thoughts and other articles on between the columns. As you can see, breadth is at 49% as of month end. This argues that the bears are in control of this market. Sub 50 is bears, above 50 is bulls. You can see for the past, since 2016, the bulls were in control as breadth maintained that positive 50% level. It peaked at a level where many stocks peaked last February. In fact, if the mega caps had sold off like much of the indexes, the S&P would be much lower at this point, we believe, than it is today. We believe the mega caps kept that up. Aside from that, though, with this model sitting at 49%, it is sitting at the cusp. Breaks of 49% translate into steeper falls in the market, such as we saw on that dip in 2018. If this bounces, however, and we're starting to see that in early June, that this model is actually turning back up, climbs back above 50, it could argue that the selling is over and a new bull market has been born. Hard to believe given the environment and given all the variables, but the stats don't lie. Sometimes this is what plays out given massive negative fear, negative sentiment, and whatnot. One last thing on terms of our numbers, as I mentioned earlier, we shorted the market down. We do very well in the down. We tend to do well on the downside of markets. We did well in the month of May. That was a major addition to alpha. Our beta statistics on the upside perform as well, and we hope that continues. And our Sharpe ratios and Sortino ratios are holding in well. Well, I thank you for joining us for the latest update on the strategies of Column E Advisors. Please read, you can read more about us at columne.com. Follow us on Twitter and LinkedIn. We post articles to Between the Columns on Mondays and Fridays. Yours truly joins OETV every Monday morning to discuss the markets. And on Friday, our top thoughts is posted. We giving thoughts of what our models tend to look at. We hope you'll enjoy it. So thank you again for joining us, and have a great rest of your week.